Ever wondered which stocks outperformed the market in 2024? The answer is the Magnificent Seven. Hailing from various sectors, these seven stocks have proven their mettle in the roller coaster ride that was the past year. The Magnificent Seven, a name as grand as their performance, comprises Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and nvidia. Each of these companies has carved out a niche for itself in the vast expanse of the market, and their stocks have performed extraordinarily well as a result. Apple, the tech giant that needs no introduction, continued its winning streak, making significant strides in the past year. Similarly, Alphabet, the parent company of Google, showcased impressive performance with its diverse portfolio of products and services. Microsoft, another stalwart of the tech industry, managed to maintain its strong market position through constant innovation and strategic partnerships. Amazon, the world's largest online retailer, continued to grow, demonstrating the power of e-commerce in today's digital age. Meta, previously known as Facebook, has been making headlines with its ambitious plans for the metaverse, driving interest in its stock. Tesla, the electric vehicle and clean energy company, has been a game-changer in the auto industry, and its stock performance has reflected that. Lastly, nvidia, a leading player in the semiconductor industry, has been riding high on the global chip shortage, making it a standout stock in the past year. According to Goldman Sachs's equity research team, these stocks are expected to continue their stellar performance in 2024. The Magnificent Seven are not just outperforming the rest of the S&P 500, they're setting the pace, establishing trends, and pushing boundaries in their respective sectors. But as we look ahead, it's important to remember that while past performance can provide valuable insights, it's not a guaranteed predictor of future success. Always do your due diligence and consider seeking advice from a financial advisor before making investment decisions. These high-performing stocks have set the stage for the rest of the market. The Magnificent Seven are not just stocks. They're a testament to the power of innovation and strategic growth. What drives these stocks' performance? Let's delve into key metrics. Now, what makes the Magnificent Seven so magnificent? Well, their performance is driven by a variety of factors, and we'll focus on three key metrics that have been instrumental in their growth. First, we have the compound annual growth rate, or CAGR. This is a measure of how much a company's earnings grow each year. Between 2013 and 2019, the Magnificent Seven saw a CAGR of 15%. To put that into perspective, the rest of the pack only grew by 2%. Looking ahead, Goldman Sachs anticipates the Magnificent Seven will maintain a CAGR of 11% from 2023 to 2025, while the rest of the S&P 500 is expected to grow at a rate of 3%. Next, we have the net profit margin. This is the percentage of revenue that a company keeps as profit after accounting for all its costs. The Magnificent Seven's net profit margin stands at an impressive 19%. Almost double the 9.8% margin of the other companies. Lastly, let's talk about long-term earnings per share growth expectations. This metric reflects how much a company's earnings are expected to increase in the future. For the Magnificent Seven, expectations are set at 17%, significantly higher than the 9% expectation for the rest of the companies in the index. These figures clearly highlight the robust performance of the Magnificent Seven. They've consistently outpaced the rest of the market, and the expectations are that they'll continue to do so. But remember, while these metrics are a good indication of past and potentially future performance, they're not a guarantee. It's always wise to do your own research or consult with a financial advisor before making any investment decisions. These metrics are a testament to the Magnificent Seven's potential going forward. The Magnificent Seven aren't just leading the pack, they're setting the pace. With a proven track record and promising forecasts, these stocks are truly living up to their name. The Magnificent Seven has outgrown the rest, and here's why. Let's delve into the world of compound annual growth rate, or as we like to call it, CAGR. This metric paints a clear picture of how our Magnificent Seven have performed over the years, and it's quite the sight to behold. From 2013 to 2019, the Magnificent Seven presented an impressive show of growth. Their stocks grew at a CAGR of 15%. Now that might not sound like much, but let's put this into perspective. During the same period, the rest of the pack in the S&P 500 could only manage a growth rate of 2%. That's a stark contrast, isn't it? The The Magnificent Seven outshone the rest, growing at over 7 times the rate of their peers, but that's not all. Let's fast forward to the future, specifically from 2023 to 2025. Goldman Sachs, one of the leading global investment banking, securities and investment management firms, has made some interesting predictions. They see the Magnificent Seven continuing their stellar growth, but at a slightly moderated pace, with a CAGR of 11%. You might wonder why the rate has dropped, but remember, as companies grow larger, maintaining high growth rates becomes increasingly challenging. Now let's compare this with the rest of the S&P 500. Goldman Sachs predicts a CAGR of 3% for them. Once again, the Magnificent Seven outpaces the rest, growing at almost 4 times the rate of their peers. The compound annual growth rate is an essential element in understanding why the Magnificent Seven have outperformed the broader market. It's a testament to their consistent growth and strong performance over the years. This growth rate is a significant factor in their outperformance, a testament to their resilience and ability to adapt to market trends. Their growth rate is a major factor in their outperformance. Profit is a significant measure of success. Let's see how the Magnificent Seven fares. When it comes to gauging the performance of a company, net profit margin stands as a substantial metric. This figure shows what percentage of each dollar earned by the company is actual profit. It's a powerful tool that delivers insights about a company's pricing strategy, cost control, and overall efficiency. Now let's shift our focus to the Magnificent Seven. These power-packed companies, Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and nvidia, have continually outperformed their competition, and their net profit margin is no exception. The Magnificent Seven's net profit margin stands at an impressive 19%. To give you some perspective, the average net profit margin for the rest of the companies hovers around 9.8%. The significant difference illustrates the superior efficiency and profitability of the Magnificent Seven. The high net profit margin of these companies is a testament to their effective cost management and strong pricing strategies. Whether it's Apple's premium pricing approach or Amazon's scale-driven cost efficiencies, each company within the Magnificent Seven has its unique strengths driving their profitability. These companies have managed to maintain their high net profit margins even amidst market volatility and economic uncertainties. This resilience is a key factor that makes them attractive to investors. However, it's essential to remember that while a high net profit margin is indicative of strong profitability, it's not the only factor to consider when evaluating a company's performance. A comprehensive approach that considers multiple financial metrics, market trends, and industry dynamics is always the best route. In the case of the Magnificent Seven, their high net profit margin, coupled with strong growth rates, robust earnings per share, and a promising market position, are all factors contributing to their impressive track record. A higher net profit margin is another reason behind their stellar performance. There's no doubt that these 7 companies have set a high bar in the corporate world, and their net profit margin is a clear testament to that. Earnings per share matters to investors. The Magnificent Seven doesn't disappoint. Let's now dive into the realm of earnings per share, or as it's commonly known, EPS. This metric is important because it gives investors a slice of the company's profit on a per-share basis, providing a concrete way to compare profitability across companies. When we look at the Magnificent Seven, Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and nvidia, their long-term EPS growth expectations are truly impressive. That's almost twice the rate of the remaining companies in the S&P 500, which sit at a more modest 9%. So what does this mean? Essentially, the Magnificent Seven are not just earning more, they're also efficiently converting those earnings into profit per share. This shows a high level of financial management and suggests a promising outlook for these companies. But let's put this into perspective. If you're an investor, a higher EPS can translate into a higher stock price, as it often leads the market to value the company more highly. So when the Magnificent Seven show a 17% EPS growth expectation, it indicates that these companies are likely to generate higher financial returns for their shareholders. However, as with all things in finance, it's not quite as simple as it seems. Other factors, including market conditions, the company's overall financial health, and even global economic trends, can influence the actual returns. Still, The fact that the Magnificent Seven's EPS growth rate is almost double that of their counterparts is a strong indicator of their potential for continued financial success. These companies are not just surviving in the competitive market, they're thriving, and they're set to continue outperforming the rest. Their EPS growth expectations further solidify their position at the top. What does the future hold for the Magnificent Seven? Let's speculate. As we look ahead, Goldman Sachs's equity research team paints a promising picture for the Magnificent Seven in 2024. Based on the key metrics we've discussed, these titans of technology and innovation are expected to continue their trend of outperforming the rest of the S&P 500. From 2023 to 2025, the Magnificent Seven is projected to grow at a compound annual growth rate of 11%. That's a significant leap from the 3% rate anticipated for the rest of the S&P 500. This growth is not just impressive, it's a testament to the resilience and adaptability of these companies in an ever-evolving market. Moreover, the Magnificent Seven's net profit margin is also expected to continue outshining the competition. With a 19% margin, it stands head and shoulders above the rest of the companies, which average at 9.8%. This suggests that the Magnificent Seven not only generates substantial revenue, but also effectively manages its costs to maximize profitability. Let's not forget the long-term earnings per share growth expectations. The Magnificent Seven is set to see a 17% growth, almost double the 9% expected for the other companies in the index. This could translate to a higher return on investment for shareholders and further solidify the Magnificent Seven's dominance in the market. Of course, these predictions are just that, predictions. They're based on past performance and current trends, and as we all know, the market can be unpredictable. Past performance is not a guarantee of future results, and it's essential to do your own research and consult with a financial advisor before making any investment decisions. But with that said, the future seems promising for the Magnificent Seven. These companies have consistently shown their ability to leverage innovation and adapt to change, driving their growth and success. As we step into 2024, we can't help but anticipate the further strides they will make. The future seems promising for these market leaders. The Magnificent Seven have outperformed in 2024, but what does this mean for you? As we draw to a close on this riveting journey of financial discovery, let's take a moment to recap the key points that have emerged from our exploration. The Magnificent Seven, a moniker we've given to the stocks of Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and nvidia, have shown an impressive performance in 2024. This group of tech and innovation powerhouses have consistently outpaced the rest of the S&P 500, earning them a reputation as a formidable force in the stock market. This performance is not accidental, but rather a result of a variety of key metrics that these companies excel in. One such metric is the compound annual growth rate, or CAGR. From the years 2013 to 2019, these stocks grew at a CAGR of 15%, dwarfing the 2% growth rate of the rest of the pack. Looking to the future, Goldman Sachs projects that from 2023 to 2025, the Magnificent Seven will continue to outpace their counterparts with an expected CAGR of 11%, compared to a modest 3% for the rest of the S&P 500. Another significant factor in their success is their net profit margin. The Magnificent Seven's net profit margin stands at a commendable 19%, towering over the 9.8% average of the other companies. Let's not forget the long-term earnings per share growth expectations. For the Magnificent Seven, this expectation is 17%, almost double the 9% expectation for the rest of the companies in the index. These figures paint a very encouraging picture for the Magnificent Seven. However, it's essential to remember that past performance is not a guaranteed indicator of future results. While these stocks have demonstrated impressive growth and potential, the stock market is a dynamic and unpredictable entity. As such, it's always a good idea to do your own research, stay informed, and consult with a financial advisor before making any investment decisions. In the world of investing, knowledge is power. Understanding the driving forces behind successful stocks like the Magnificent Seven can provide valuable insights and help shape your own investment strategy. But remember, each investor's circumstances are unique, and what works for one may not work for another. So as we conclude this exploration of the Magnificent Seven, let's remember the importance of staying informed, understanding the metrics that drive stock performance, and making educated decisions based on our own individual circumstances and goals. Remember, the key to successful investing is staying informed and making educated decisions.